unit of foreign currency, like this one. I used a simple E to denote exchange rate. So this means 150 rupees per dollar. 150 rupees per dollar. That means how many domestic rupees, domestic currency units we need per foreign currency unit. You can also express this in the same thing in inverse form. That is the amount of foreign currency units per unit of domestic currency. In other words, it means how many dollars per rupee. So you get the inverse by dividing 1 from this one, and then $0.0067 per rupee. So the exchange rate can be expressed in both ways. Now, when we are talking about a market, we have something to be supplied or demanded, something to be sold and bought. But in this particular market, which also works according to in line with all other markets, but in this particular market, one difference is that we are trading currencies, foreign currencies. So our price is in domestic currency, and we buy and sell foreign currency. Therefore, we can also express that our price in terms of foreign currency, how many rupees demanded and supplied, either way. That's the specific feature of this market because it is trading currencies. Foreign exchange market, so in any market, we know that we have supply, we have demand. So in this market also we have demand and supply. This is the market where foreign and domestic currency transactions takes place. So the market where currencies are bought and sold at a price. So the price is called exchange rate. Price is called exchange rate. Currencies are sold, currencies are bought, and we pay the price, this one. So that we have demand and supply of foreign exchange. The term we are familiar with because we know now the price of the currencies, the exchange rate is determined by demand and supplies for the currencies in the currency market or foreign exchange market. Right. So when we look at try to understand demand and supply of foreign currency, foreign exchange, essentially we need to look at balance of payments. What is balance of payments? It is a statistical record similar to balance sheet of a company, which records all types of official foreign exchange transactions. Official foreign exchange transactions. So if it is about Hawala or Undial system, of course, they are not reported by balance of payments analysis because they are informal foreign exchange transactions. That's why I mentioned all types of official through the proper banking and financial market channels, if the transactions are taking place through that, all those transactions are recorded in the balance of payments, BOP. Let me show you a structure of the balance of payments, the summarized version. This is the structure of the balance of payment. For detailed ones, you should refer to the central bank report, external sector chapter will give you, or the statistical appendix will give you a detailed structure of the balance of payments for Sri Lanka with the relevant numbers. So here we got the same thing, but in summarized form, because this is important for our discussion for the next few minutes. Now you can see there are two important accounts in the balance of payment. One, as you know, you call it current account. In our model, we are talking about actually trade in goods and services. The second account, capital and financial account. And for our purpose, we are talking about their trade in assets. Trade in assets. So they may be real assets, so they may be financial assets. Two accounts. First on trade in goods and services. We are looking at how the sources of foreign exchange demand and supply. How do we identify these? So in the current account, practically you have four kinds of transactions there. Trade in goods, which we call merchandise trade, and trade in services, the second. Third, primary income. Fourth, transfer payments. But most important thing in this account is international trade. So we are looking, in fact, in our model, we are incorporating international trade, not the other. So we look at international trade, how it brings supply and demand sources of foreign exchange. When we do exports of tea, rubber, coconuts, garments, or exports of services such as banking, insurance, trade, healthcare, education, tourism, all these things. They are the supply sources of foreign exchange. Because they bring foreign exchange, we receive foreign exchange, receive side. So all the sources of international trade related supply sources are recorded under this account. Then the reverse direction is of the same thing. We call it payment. And that constitutes demand for foreign exchange. So we have supply and demand. If you want to import something from another country, if you want to buy something from another country, you need to first buy foreign exchange from a bank. You go to a bank, whether it is an individual or a company or an importer or a government agency or Ceylon Petroleum Corporation, they all, even the government, they all do the same. What is that? They demand for dollars. So if you want to buy service, you want to go abroad, you want to buy an airline ticket for a foreign airline, you want to buy healthcare services from India, you want to buy education services from Australia, you demand for foreign exchange. So they are demand sources. So you understand now exports constitute all kinds of exports, constitute supply sources, and all kinds of imports of goods and services both constitutes demand. Then when we get the balance of all these things, we will have either deficit or a surplus. The second account is called capital and financial account. Capital and financial account. So why we have capital and why we have financial? Capital account explains transactions in real assets. So when we sell our companies to foreign entities, that is capital transaction. When we sell land, piece of land, when we sell our Hambantota, those are real transactions. And then we have financial account for financial transactions. What are the financial transactions? They are called two types financial transactions. Number one, FDI, foreign direct investment. So if we receive foreign investment, that is an inflow. But if our companies take their businesses abroad and set up their hotels or factories or whatever it is in other countries, that is outbound FDI, inbound FDI, and outbound FDI. The first, I said there are two kinds of financial accounts. The first one, FDI. So when we receive FDI, it is a source of supply. In that case, we sell our assets. The second type of financial account is called portfolio investment. And this is the foreign investment coming to the stock market or the bond market. So borrowings are included there, okay? That is also a supply source. So we sell our financial debt instruments to foreigners, including company stock. So they constitute supply source. So all kinds of foreign exchange receipts through direct investments, through borrowings, short-term borrowings, long-term borrowings, whichever the way you define, private borrowing, government borrowings, everything. They bring foreign exchange supplies. And the reverse order, in the reverse direction, those things are happening. That will generate payments. So if Sri Lanka is lending to any other country, if Sri Lankan investors buy stocks in other countries, buy bonds in other countries, they have to spend foreign exchange. So they should buy foreign exchange first from our banking system in our foreign exchange market, and then they can purchase foreign assets. So that constitutes a demand. Now, these are asset transaction. You can see trade in asset. So one difference is that you keep the assets for a period of time and then you return it. So when we sell our assets, financial assets, we bring foreign exchange, but when the foreigners return them, we purchase back so that it will create payment. So the same asset transactions, they have two-sided transactions. If a foreigner purchases a bond, we receive dollars. But at the maturity, the foreigner take that back, then we have to pay in dollars. So there is a supply source, also there is a demand source. Even the stock market, similar to that, unless they are converted to long-term or indirect investment. So the capital account. Capital account. Capital demarcate current and capital transactions. Well, I think you are talking about current account and capital account. The demarcation in practice is exports and imports come under current account. Primary incomes and primary income payments and receipts come under current account. And transfer payments and transfer receipts come under current. That's all. And then the capital and financial account carries purchases or sale of real assets and debt instruments and stock market operations. So that's the distinction between the two. So you have the two accounts, and then there also you may find deficit or surplus because these are millions of each other. So you don't expect a surplus there or here. But when you get the two, both accounts together, you have now overall balance, which can also be a deficit or a surplus. Then we have a question that then what do we talking about balance of payment problem? That's a topic beyond our discussion, but anyway, I will give you a basic premises to understand the answer to that question. By looking at the numbers, you cannot come to the conclusion that whether the country has a balance of payment problem or not. Numbers do not explain that directly because millions of decisions and ultimately at the end of the year, 365 days, people have been doing these things. So they don't expect, nobody is anticipating we should have balance, zero balance at the end of the year. No, it's not the case. The case is that you need to, there is a saying that balance of payments problem cannot be quantified but analyzed. It can be analyzed but not quantified, which means by looking at the number, whether it's a deficit, you can't say it is bad. When you see a surplus, you can't say it is good. Then, how do we understand the country has a balance of payment problem? There are various ways to understand that. You need to look at trend, long-term trend, where the country is moving. And if the deficit is getting widened, you need to understand there is a problem. And if this side is getting weaker, that means current account transactions are weaker, then you need to understand there is a problem. If this side is getting stronger, and that stronger accounts may be borrowings, then you need to understand that there is a problem in the balance of payment. So those are the ways and means of identifying the balance of payment issue. Also, there are autonomous transactions and accommodating transactions. Accommodating transactions are here in this account. So you look at autonomous transactions and their trend. What is where the country is moving in terms of. So you go deeper and deeper and deeper, analyzing how do we get foreign exchange and how do we spend that foreign exchange, and then understand there is a problem. So Sri Lanka is a country which has a perennial balance of payment problem. So when you look at our issues in the foreign exchange, that's the way to understand balance of payment problems. Okay, so demand for foreign exchange, I use here dollars. So all sort of payments or outflows constitute the demand. All sort of receipts or inflows constitute supply side. And those things are given in our balance of payment sheet when you look at the detailed balance of payment sheet. So that you can have at the end of this one either a deficit. When you have a deficit, we call it excess demand, right? In other words, it is excess demand because you need to pay more than what you earn or what you receive. Excess demand for foreign exchange. When you have excess supply, then we call it a BOP surplus. Some basic stuff to understand BOP. So this is again explaining the same thing that I explained there. You can see demand sources for foreign exchange, which are also called payments. In the current account, purchase of goods and services from abroad. In the capital and financial account, sale of domestic currency assets held by foreign residents when they keep our bonds, our stocks, and they want to sell them, then it will generate payments. Or purchase of foreign currency assets by local residents. So there are two things here. Either way, they generate capital outflow. So that is the demand side. Supply side, under the current account, you have sale of goods and services abroad, that is export earning. And then in the capital and financial account, you have purchase of domestic currency assets by foreigners. Here, foreigners sell whatever they have. Here, they purchase assets. or even sale of foreign currency assets held by local residents. Either way, they generate capital